Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
All right, here we are. This is us. We're finally live. Welcome to the Focus Compounding Podcast. If you're viewing this on the video version, thank you so much. If you're with us on YouTube, if you're listening to us on the podcast or Spotify, also thank you for that. We aren't going to break up the podcast anymore. We actually have video up. So if you like to consume the content by watching us have our conversation, feel free to go to YouTube, and it's just Focused Compounding, and that will bring you to us. If you are just a podcast listener, thank you so much for tuning in with us on that avenue as well. Mr. Geoff Gannon, say hi to the camera.
Hi.
Hello. It's so funny. It's so weird being in this version. We're like still in the office where we normally record, but now we're like sitting much closer. And thank you so much for tuning in. We're kind of going to play with this probably for the next couple of weeks till we find something that we like, but we're going to kind of roll with it. So if you are listening and you want to join Jeff's weekly Gazette that he sends out. We used to call it a memo, but now we're calling it a Gazette, getting really fancy. Yeah. Go to focuscompoundinggazette.com and you'll see a 2,000 normally plus word free stock write-up. And then we're going to also put other stuff in there as well. And I get a weekly column called What's on Andrew's Mind. Mm-hmm. So if you're interested in that, definitely sign up for that. And then that'll get you on the email list. So today we're going to be going over for this podcast a bunch of questions that people have asked of us. Again, if you want to have a question answered on the podcast, feel free to DM me or email at info@focuscompounding.com. I compile them all together, and then we'll definitely bring them up on the show if it's something that we think is relevant. And we'll just jump right into it. So the first question that somebody asked, he says, since overlooked stocks are more obscure, how do you go about finding ideas?
Well, you probably know the answer to this, but we were actually just talking recently with the guy who runs Kenkyo Investing, and I was talking about how I don't run screens. He was talking about the same thing, that he doesn't run screens. And so the truth is mostly getting it from people who know what I'm looking for. So mostly from people who also run sites, who invest themselves, manage funds, all sorts of things like that, have an idea. They want me to look at the idea sometimes to give them my opinion about it. Sometimes we just share ideas, that sort of thing. I mentioned Phil Fisher, talked about that. Sometimes that was during his life his best source of ideas, and I found that to be true too.
From other people?
Talking to other people who know, if they know you, they know what kind of thing you're looking for.
It's like
if they don't,
taking the Monish Pabrai route, right? He says how he doesn't have an analyst team and how he thinks like having an analyst team is actually would detract from being a better investor. But he says that people send him ideas all the time.
That's true.
And they say, hey Monish, you're looking for your PEs of 1 or whatever international. He looks for, I would say, a lot of stocks are overlooked. Maybe not Fiat Chrysler, but he's a big investor in like India and of course invests in other companies that no one talks about. But he has said before that people just send him ideas all the time, and that's a good source of idea flow for him. Yeah.
So also there's certain sites and things where I gather all of the names of stocks they've ever looked at.
Yeah.
So I've talked about that before. We had Nate from Oddball Stocks on. And I've taken every stock that he ever wrote about, put it in an Excel file, keep track of all that. That's true for Corner of Berkshire and Fairfax, Value Investors Club. What I do is I take all the names of anything they've covered before in the past, and I keep them offline to have those ideas. Also, anything I've looked at myself. A lot of ideas are from things that I looked at, 5-10 years ago, and then the price of the stock changed.
Yeah, sure. Yeah. And we tweeted out a good piece of content on how to define an overlooked stock.
Okay.
And this is something that you've kind of refined, I think, since running our firm. So do you want to tell them how you define an overlooked stock? The
main way for finding overlooked stocks is the number of shares traded divided by the total number of shares outstanding. That's the most useful number. We actually did a podcast where we talked a lot about that number, like sort of talked about it as an illiquid measure of illiquidity, but it's not just a measure of illiquidity. It actually tells you sort of how interested people are in the stock. Another thing I was talking to someone about recently is actually if you look at a stock's beta. So it tends to be, surprisingly, that the number of shares traded divided by the shares outstanding and the beta are much more correlated than you would think. So actually very low beta stocks tend to be a better place to look for overlooked things.
Because they don't, I mean, technically, if they have a beta less than 1, they're not exactly moving with the market.
Right.
So you're saying that that could mean that they're just more overlooked. People aren't looking at these ideas.
Yeah, it's not clear why that happens exactly. This is an interesting question. They also tend to outperform the market. Both shares traded divided by shares outstanding and very low beta.
Yeah.
And so why is this? For some reason, they move less with the most of the things that funds buy. Most of the things that individual investors buy, they don't move as much with the market.
Yeah.
And it's unclear why things that don't move as much with the market perform so well and are overlooked that way. It's also, the reason why I would also use low beta is because it's something you can find at a lot of websites.
Yeah, sure.
So a hint that something might not be overlooked is if it has a beta around 1. Now, that's not a guarantee. We've owned stocks that maybe briefly, depending on how places measured it, if some websites were using a very short-term measure of beta, it might look kind of high. I don't know that we've ever owned anything that's much above 1. And usually it's a lot below 1.
Do you think that could be kind of skewed? Because since owning NACO, the beta's definitely gone up, but really because it's only had like 1 or 2 big moves. You know what I'm saying? Like it's done a lot from watching the portfolio. I feel like a lot of our companies, they do a lot of nothing and then they just have a couple big moves too.
Yeah, well, the way beta is calculated, NACO would actually not be our highest beta one, is my guess. Not my guess. I think that's correct. That's correct. And because of the way of the volatility, I know that had a bigger one-day move than anything else that we've had.
Yeah.
But yeah. So I would use both of those. I would use shares. So basically, the number that's easy to get is the average daily trading volume. So I talked about that.
Yeah.
So that's an approximation. You can take the average daily trading volume you find on a website, multiply it by 5. Multiply that by 52, and that's an approximation of how many shares would trade in a year.
And the rationale is obviously if the float's not turning over as much, then most people probably aren't familiar with the company.
Yeah. And then also check the beta too for both of those.
Okay.
So when we've talked about it, and if both of those are low, so like if you find that the beta is 0.5 and the shares traded divided by the shares outstanding are 50% in a year, that's an overlooked stock. Whereas if it's like 100, so like 100% of the shares turn over in a year, and the beta's 1, that's probably not an overlooked stock. I'm just giving you both of them because something could be happening that would throw one of them off, but they're so correlated that it's unlikely that something that has pretty high numbers in both of those would be overlooked.
Sure.
Yeah.
No, I think that's a pretty good explanation. Okay. Next question, and let's just get this out because so many people have been emailing me and messaging me on Twitter, and this is all your fault, and you gave no explanation.
Right.
It says, what happened to the Gannon on Investing blog? Is all the old content gone? This is how how you and I came to be, was your blog.
That's correct.
And I've been reading your blog for a very long time. And I was telling Geoff on the way here that even myself, if I want to look up an old article or an old concept that Geoff wrote about in the past, I would just type in, okay, for example, free cash flow on Google, free cash flow, Gannon on Investing, or Geoff Gannon. It would bring you right to all of your articles.
Right.
They're gone. They evaporated.
Yeah, it's been replaced with the focuscompoundinggazette.com.
There's a lot of people are upset.
Yeah.
How can they get access to all that old information?
Oh, well, you can use the Wayback Machine. You can use the Internet Archive, whatever it's called.
Yeah, so use Wayback Machine, and you should be able to get access to it. But
if you know how to do that, yeah. But if not, we'll give you the information, and you'll probably be tweeting that stuff out over time.
Yeah, probably. So follow me on Twitter. @FocusCompound.
That'll be better because it's an easier way to rediscover some of the things. There's so much on there that no one looks at because they don't know where it is and how to find it. So it'll be an easy way for you to do that, to put it out with some context. Yeah.
Cool. Next question. How do you screen for international stocks? Is your screening different from when you screen for U.S. companies since the accounting can be different overseas?
Yeah, so I would only screen for like EV to EBITDA if I was running screens internationally.
So you're moving up the income statement pretty much.
Yeah, you don't. But that's true for most things I do. I find almost nothing through screens. And when I do run screens, I use a very wide net, like something like EV to EBITDA. The reason why you would do that is it's easy to have something thrown off by accounting differences or something like that.
Yeah.
I have I use a particular site in the UK, but generally for most countries, I don't screen and stuff. And I'd say a lot of the screening stuff isn't very reliable in a lot of countries. So I get most foreign ideas that we have from talking to people from that country.
Got it. Cool. When valuing a company, do you consider earnings to be net income or free cash flow? Or, sorry, cash flow from operations? And I thought it was a good question because everyone kind of has, sometimes people do it based upon like EBITDA, EBIT. Right. We've talked about sometimes we do it on price of sales. I think it really depends on the company, but he asked for free cash flow from operations, or net income.
Yeah. I mean, you calculate it yourself using common sense for each individual case. We own a timberland company. They can report higher free cash flow or higher earnings if they cut down more trees, but the way that I calculate their earnings wouldn't change based on how many trees they cut down. So it just has to do with their with how much I think the value that you get for it. So I would say it depends. Often for something like a insurer or something, you would use the change in book value, so comprehensive income. Comprehensive income is often a better measure than net income. I can't really think of any case where it would literally be net income. Comprehensive income is closer to how Berkshire used the calculation of the change in book value.
Yeah,
it takes into account other things which don't appear in the income statement or don't appear in the net income statement. Net income is the least likely to use. Free cash flow, yeah, but free cash flow also can be thrown off by yearly things. Any 1 year's free cash flow isn't that reliable of a measure. For some companies it is. For a service type company, it's fine. We own a core processor. We own something that's an information type systems company too. And in that case, it's probably pretty accurate. But that's just sort of because it doesn't matter that much. I mean, I've talked to people about like ad agencies or something like many service companies.
Yeah.
Free cash flow, earnings, they're barely different, maybe 5% different. Any given year is pretty accurate what your level of earnings is. But when you're talking about other kinds of companies that are not service companies, that are more cyclical, then this year's earnings are not the calculation that I'm making. I'm not using this year's earnings ever.
Do you think, and obviously this is a great question because we get asked stuff like this all the time, but do you think when you say stop reading investing books and start actually like reading annual reports, this is one of the reasons why, so you could get real world common sense of how to value companies and stuff like that?
Like you sent out something where I said we don't like to pay more than 13 times earnings.
Yeah.
I hope people don't misunderstand that to mean that if the PE is 14 or something, we won't buy it. Sometimes the PE is 12 and it's actually a lot more expensive than 13 times what I think earnings are.
Yeah.
But sometimes it's less. I bought a company, Frost, years ago, and I think it was around 13 times earnings, maybe a little tiny bit less than that. But that was a bank, and the Fed funds rate was 0.25%. So I figured I was actually buying it at more of like a single-digit type PE ratio. Similarly, I bought Hunter Douglas, and my calculation there is based on normal amount of housing activity. So, and there hasn't been any, by my measure, and maybe people disagree, but the housing market hasn't been normal since the crisis. So we've had no years that I would calculate as being actually in line with long-term trends. So every year, so I would say their earnings have, for what is it now, 10 years in a row, have been below what I would consider their normal earnings to be.
Got it.
So it depends on cyclical issues and things like that. For service type companies, free cash flow is usually better.
Because they throw off cash?
Yeah, I mean, free cash flow is what matters, the increase in value. But I mean, we've also done things, when I research things that have to do with real estate or something, then I'm using, comprehensive type numbers or fair value type numbers, yeah.
Got it. This is a question I can answer.
Okay.
What's the process for becoming an investor in your firm?
Okay, go ahead and answer.
And we custody all of our assets at Interactive Brokers. So really from there, when a client says go to us, we send them a email that comes from our master account, but it's from Interactive Brokers. The client opens up the account in their name. We're just the managers on the account and just allocate the portfolio. Really from there, I've spoken to every single one of our investors. I like to really chat with them beforehand because we do know that our assets are going to top out at some point. So we
Yeah.
want to make sure that we have the right type of investors in our firm, which we've been very grateful for, because I mean, I talk to our investors. How many times have you talked to our investors?
Twice, maybe.
Yeah,
maybe twice.
Yeah. So, we just have a very good group of investors. And, I was speaking to someone recently, and he was saying that he doesn't check ever, and that he checks the monthly letters that Geoff sends out, but, it's really hands off. So we kind of vet everyone that does come to us. But that's the process, is really just, reach out, info@focuscompounding.com, or you go to Focus Compounding on the Invest With Us page and set up a time to chat. You'll be speaking with me. All correspondence goes through me. But you can expect a letter from Geoff once a month, and then a quarterly letter as well.
It's not a long letter. Yeah.
No, it's just a memo.
Yeah,
it's just a one-page memo on. Sometimes it's changes within the portfolio, or just whatever's pretty much on his mind.
It's usually something that I don't want to discuss publicly. So it's like a new position or something. It's things that I won't talk about with non-clients. Yeah.
Yep. So that is how you do that. Okay. Next question says, some fund managers like Joel Greenblatt talk about feeling more indifferent about their personal portfolios, but having more feelings about the money they manage for other people. What has your experience been?
Yes. Yeah.
Yes.
I've said before, for one thing, I'd own fewer stocks if it was just me. We've tended to own 5 in the managed account, sometimes a little cash. So, you could call that 6 or something in terms of number of positions, like slots that there are in the portfolio. Basically, I would probably own 3 or something if it was just me. Mm-hmm. So in terms of daily moves, it does sometimes make me think about that. I never think about a stock moving up for the day unless there's some big event that happened. And I know that sometimes if people are checking things, that they would see that and they wonder about it. Sure.
Especially since we are a managed accounts firm.
Yeah.
They see what goes on daily. They can watch it minute by minute if they want.
And when we started out, that was one of the questions that I had a lot about whether we wanted to do that. Managed accounts are great for clients, but the downside is they get to see everything. And so I wondered how much people would think about daily fluctuations and things. Yeah. Because especially with wide bid-ask spreads and things, we sometimes have 4 or 5% moves in one stock just from people putting in orders or not putting in limit orders or whatever it might be, which isn't really a change in the value of the stock probably. Sometimes you see the last trade moves 4 or 5% without the bid and the ask moving. And to me, if the bid and the ask didn't move, then really there's been no change in the price really.
Sure.
But that can confuse people. We have things in foreign currencies. So movements in, things in foreign stock markets which aren't hedged. Yeah. So movements in that currency would show up to people, all sorts of things like that. So you
would own fewer stocks, is what you're saying, though.
I would own fewer stocks. Yeah, definitely.
And we're already very concentrated. And one thing I found interesting, so I tweeted out last week, it was Monish Pabrai. I think he was speaking to London Business School. And I always talk about this concept of moving upstream to learn about people who you otherwise couldn't get into contact with. Mm-hmm. And, so for example, I probably can't get into contact with Warren Buffett or Charlie Munger, right? But Monish has said that once a month or whatever, he meets up with Charlie to play bridge, and he's willing to share these stories in these talks. So it's you could learn a lot about these people just from people that are sort of in their circle. Right. But Monish was saying that he's been on the Buffett archive, and he went to it's buffett.cnbc.com or whatever, and he was in 1996, and I think Buffett was talking about a stock that he personally owned. Mm-hmm. So recently, Monish was asking Mr. Munger, what stock Warren Buffett was talking about in his personal portfolio, and he said that Charlie couldn't remember, but when they started, or when Berkshire became a thing, him and his wife kept around 20 to 30 million outside of Berkshire, which was his personal portfolio.
Buffett's,
yeah, and Munger said that portfolio, that value is now anywhere from $2 to $3 billion. But he did say when he was investing in his own personal portfolio, he owned majority of the time 2 to 3 stocks. Sometimes he did stuff with leverage, sometimes he did stuff with options, but majority of it was 2 to 3 stocks. So I just thought it was kind of interesting, because obviously he doesn't manage Berkshire like that, but in his personal portfolio he does.
Yeah, well, one case we know that for a fact with us is people may know, because I wrote about it, that before the managed accounts, I had 50% of my own money in NACO. But when we had the managed accounts, NACO, the position in NACO was not 50%.
Yeah, sure.
It was like half of that. So, why was that? It was because, I ran things differently when I had, when I was investing money for clients than I did for myself only. So, yeah, I would say that I think it's easier to run money for yourself.
Got it. Okay. Last question. This gentleman said that obviously Geoff reads a bunch of 10Ks every single week. And then he said, what are you looking for in order to qualify a business for an initial interest write-up?
Oh, so we should explain what that
means. And he
means.
said, mainly I ask, due to many of the write-ups still get slapped with a low follow-up interest rating.
Yes.
An example, 20%.
Yeah, a lot of people pointed that out, that they have very low ratings. So over at the Focus Compounding website, I write up things from time to time, and I talk about it as an initial interest post. So like the most recent one that I remember doing at the time we're recording, this might be different by the time you're seeing this or listening to this, is Farmer Mac, right? Yep. And I think I put a 50% initial interest in it. And that may have surprised people because I said lots of positive things about it throughout the whole article. But I bet a lot of the ones I've done have 50% or less, meaning that I would say there's less than a 50% chance that I'll follow up on it. So what I mean in those articles is I'm just telling you I'm not really deciding whether I like the stock or not, but I'm deciding whether I would follow up with it. And the ones I can think of from this year, they probably got pretty low ratings generally.
Yeah.
Early on, there were some that got like 90% ratings or something, and some of them ended up in our portfolio. Some, for various reasons, stuff happened with them, so they couldn't end up in the portfolio. Pendrell was one of them that got like 90%. So,
so is it really based on stuff that you think could be in the portfolio?
Yeah, but I mean, so I don't even write. So there's some that I don't even write up. So I think the question is sort of asking, if I give such low ratings even to those, then what do I find originally that even makes me want to do an initial interest about a stock? So the reason why I would do an initial interest write-up is the stock seems to have the potential to be interesting, but not that it is. So Farmer Mac was a good example of that.
Yeah.
The dividend yield was probably around 4% at the time. It was retaining 2/3 of its earnings. So it probably had a P like a little under 8 or around 8 or something like that. And it was probably growing 10% a year, or had recently grown like 10% a year. I figured that I could understand a business that was similar to like Fannie and Freddie.
Yeah.
And I figured that if it grew at all, it would have high returns that way. If you think about it, let's say a stock goes from a P of 8 to 15 over like 10 years. It has a dividend yield of like 4%. You're going to get a return of 10% or better in that stock just from the P going from 8 to 15 without any growth. So if the company grows like 10% a year, you're going to get like a 20% return over 10 years. So a stock that could return 10 to 20% a year in a financial company that I feel like I know enough about financial companies that I could analyze it. So it had that potential. I decided with that one it wasn't an overlooked enough stock for us. There was another stock that I did that I give a very low rating to, very low initial interest rating to, and it had something to do with the Auditor. I didn't like the Auditor and stuff when I looked into it. But you can understand that if I had found that I loved the management of that company, given the valuation and things like that, like on the numbers, it looked like it could be potentially interesting. So it really depends. If it looks interesting on the numbers, then I might do it. So it's basically by looking at like a 10-year history of the company, maybe the PE, the price to book, the return on equity. Is the return on equity 10% or higher? Has it had a long series of profitability, things like that, that it might be interesting. I did in the Focus Compounding Gazette that we put out recently, I had 10 overlooked stocks to watch. That's a good example because I'll pull whatever initial interest posts I do from that list of 10. So like my next one is going to be one of those 10, I can tell you now. And that's a good example of what kind of things I look at and then pass on.
Yeah.
And a lot of them you can see in that list. And they'll come out each week. So if you sign up for it, you can see what 10 those are. It has the potential to be interesting, but something might disqualify it. And so usually what we're talking about why I wouldn't write it up is something disqualified it. And I don't really get into talking about the stocks that I pass on so quickly that way.
Yeah.
Like one of the ones I wrote up with the Auditor issue, that I didn't like the Auditor,
What was that company?
See, I probably shouldn't have written up at all.
Yeah.
Because so I did a very long post about it.
Yeah.
But I should have discovered earlier on that I wasn't happy about that, and that was going to eliminate from consideration. Same thing like with Farmer Mac. I was going back and forth. Is it overlooked enough? Is it not? And so with the ones that I don't write up, there's something quicker that I decide to eliminate them. There was another one that I should have eliminated because I felt we couldn't get enough shares of it for the managed accounts. But it wasn't 100% clear that would be the case immediately to me. It was pretty clear, but not 100%. And so I already started doing work on it, so I figured I'll just put out an article for members because I've done so much like looking at it. You know, they like to see what I'm looking at, and maybe they would buy it personally at some time or something, you know. So, because that was like a $2 million company or something. So that's really not possible for us to invest in unless there's something really unusual with like no insider ownership, lots of share turnover. But there's a $10 million company that's on the watch list, and it's possible for us to invest in. It would be difficult, but not impossible. So I could definitely write that up. So you can't know right away.
Cool. Well, I want to thank everybody so much for tuning in with us in today's podcast, whether you are on YouTube or listening to us through Spotify or the podcast app. Want to thank you so much, and thanks for bearing with us. You know, we're gonna see how we like this audio. Maybe we'll change up the background or get a new situation going. But we're gonna kind of roll with it, and we're gonna get better. So I want to thank everybody so much for tuning in. If you are watching on YouTube, feel free to subscribe and hit that thumbs up button. That's good for YouTube. And then if you're on iTunes, leave us a rating and review, and we'll greatly appreciate it. Hope everybody has a great day. We'll see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.